So I'm still long-term bullish, and I wouldn't say I'm big on crypto in general. I tend to be pretty skeptical of the majority of the crypto space. For me, it's so far been really Bitcoin and stablecoins that I think are the most interesting, and then there's little pockets elsewhere that are kind of also kind of interesting. But for the most part, it's pretty concentrated. I'm long-term bullish on Bitcoin still. Nothing's really changed with that thesis. The way that I'm interpreting this year is that the ETFs. Pulled forward a lot of excitement. People started to get really bullish in like February and March of this year. And we've seen kind of a slow draining of these kind of overinflated expectations since then.
Lyn Alden starts by reaffirming her long-term bullish stance on Bitcoin, but with a distinction. While many crypto enthusiasts spread their attention across a wide array of altcoins, Alden maintains that Bitcoin and stablecoins are the most valuable components of the crypto ecosystem. She views Bitcoin as a standout, tracking global liquidity more accurately than any other major asset class, including stocks, gold, bonds, or emerging markets. Alden points out that Bitcoin's correlation with global liquidity is significant over 80%, which makes it a strong barometer for changes in broad money supply across the globe. Her approach to analyzing Bitcoin centers on liquidity trends rather than short-term price fluctuations. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So I'm still long-term bullish, and I wouldn't say I'm big on crypto in general. I tend to be pretty skeptical of the majority of the crypto space. For me, it's so far been really Bitcoin and stablecoins that I think are the most interesting, and then there's little pockets elsewhere that are kind of also kind of interesting. But for the most part, it's pretty concentrated. I'm long-term bullish on Bitcoin still. Nothing's really changed with that thesis. The way that I'm interpreting this year is that the ETFs. Pulled forward a lot of excitement. People started to get really bullish in like February and March of this year. And we've seen kind of a slow draining of these kind of overinflated expectations since then. The big metrics that Bitcoin tends to track, and actually I've commissioned a report from an analyst I like, and I'm advising it that we're kind of quantifying this a little bit more. But Bitcoin tracks global liquidity better than any other major asset class, so better than stocks, better than gold, better than emerging markets, better than bonds. And there's different ways to measure global liquidity. In that report and in general, I define it as global broad money supply, but denominated in dollar equivalents. So you get both a credit expansion or credit contraction component, and then you get that strength of that dollar relative to the other major currencies. And basically, if that goes up or down in a given 12-month period, Bitcoin has the highest likelihood of other assets to do the same direction, which is over 80% in Bitcoin's case. So I put a lot of that focusing on global liquidity when I'm thinking about, say, a 2-year or 12-month Bitcoin price. I don't really try to judge like month by month or quarter by quarter Bitcoin price. For the political component, obviously so most Bitcoin conferences are not that political. This particular one that happened in Nashville it's the biggest one in the world, and it's during American election season. So this one was very political. I guess the interesting thing about it is that most of the headlines were the Republicans there. So obviously Trump was there. There are a number of senators and representatives that were there. But I think what went under the radar is that there were some Democratic politicians there as well, like Ro Khanna, for example. And then he and over a dozen other congressmen wrote a letter to the DNC saying that they need to embrace that industry a little bit better than they have. So right now, if you look at, there's actually a study recently by Troy Cross, a professor, and another professor, I can't remember his name, but they found that they kind of looked at a sample, pretty big sample, it was a well-designed test as far as I could tell. And they wanted to see if there was a difference between Bitcoin holders and the general public on a number of metrics, including politics. And they actually didn't find that much difference.
Really?
Yeah, the two biggest areas that stood out were Bitcoin holders skewed male and they skewed younger. but they didn't skew left or right, which was actually kind of surprising because when you look at politicians that embrace it, it certainly has skewed right. Most investors are overstating, and some that I think investors might be understating. So the interesting thing about this cycle is that during the rate hiking cycle, the economy was more resilient to the rate hikes than many people thought. And that was because a lot of the private debt was locked in at low long-term fixed rates. And ironically, a lot of the government debt wasn't. And so basically the raising rates increased the deficit more than it increased private sector interest expense that's locked in. Obviously, if you're entering the home buying market right now, that's a very different story. But when you look at the aggregate private debt out there, investment grade debt, a lot of it was unimpacted by these rate hikes, and only slowly, quarter after quarter, does some of it get refinanced at these higher rates. And I think we're going to have a similar effect on the downside, which is, cutting by 25 or 50 or even up, after a couple of cuts, even 100 basis points is still above, a lot of the rates that people have locked in. Now, obviously, the long end moves differently than the short end, but overall, until they kind of hit some threshold, I wouldn't expect a very large amount of refinancing, which you normally see during those rate cutting cycles, because people use the opportunity to get out of their higher price mortgages into lower price mortgages. They unlock more consumer spending, and there's just not a lot of that ready to be financed. There were very low mortgage originations over the past couple of years in this higher rate environment. So the opportunity for refinancing is fairly low. The area that I'm more wondering about on the optimistic side is foreign equities. Basically, there's been huge long period of U.S. outperformance, strong dollar environment, strong U.S. equities. Some of that's fundamental, some of that's valuation. A lot of it's capital flows. And one of the few periods where you get a chance for rotation into international markets is during rate cutting cycles. And really, you need two variables to be in place. So one, you need to have a situation where a lot of capital is already stuffed into U.S. markets. And so, for example, in the year 2000, there was a lot of global capital stuffed into U.S. markets. The 90s were a big period of U.S. outperformance. And so the rate cutting cycle that followed that was very good for international markets as some of that capital dispersed back elsewhere. So those two variables were present. In 2008, the rate cutting cycle happened, but there was not a lot of global capital stuffed into U.S. markets. The whole 2000s decade, after that dot-com bubble, was all like the BRICS decade. So global capital was already kind of dispersed, and so rate cutting cycle in the U.S. did not really feed that. The next rate cutting cycle was the 2019 rate cutting cycle. And that was a situation, again, where it was more like 2000 in the sense that a lot of global capital was stuffed into U.S. markets. And so that was an opportunity for potentially some of that capital dispersing. But then when you had COVID, lockdowns, all the stuff we experienced, that kind of disrupted what could have maybe otherwise happened. We don't really know the counterfactual. Plus, it was the continued outperformance of the handful of top tech stocks. So I would say that this upcoming rate cycle is the first major one in at least 5 years where you have both variables present, a rate cutting cycle at a time when a lot of a lot of global capital is stuffed into U.S. equity markets. And so the rate cuts could be fairly beneficial for some degree of international equities.
Alden emphasizes the concept of fiscal dominance, a situation where government deficits are so large that they constrain monetary policy. This is particularly relevant in the current environment, where the U.S. government is running unusually large deficits relative to GDP outside of a recession. With public debt levels at historically high levels, interest rate hikes have a magnified effect on government finances, increasing the deficit further. This unique environment complicates the traditional understanding of how interest rates affect the economy. Alden points out that rate hikes are supposed to strengthen the currency and slow down bank lending. But in a world of fiscal dominance, these mechanisms may not function as expected. This has important implications for investors, as it suggests that the tools central banks use to control inflation and manage economic growth may be less effective than in the past.
I think that's an outcome of fiscal dominance. And so this was kind of the first rate hiking cycle that happened in fiscal dominance, which is to say that we're running unusually large deficits as a share of GDP outside of a recession. And we have very high accumulated public debts. And so when interest rates go up a lot, the interest expense goes up quite a bit. When you raise rates at 30% public debt to GDP, it's a very different environment than raising rates at 120% debt to GDP. And so we got into this kind of unique situation where rate hikes don't necessarily have the effect that they're supposed to. When you think of what rate hikes are supposed to do, there's kind of two main things. One is they make your currency more attractive to foreign holders or even domestic holders, so they don't go elsewhere. So you're getting a better rate on your money to strengthen it, which can clamp down on inflation. And the other one is basically to slow down bank lending. So, for example, when Volcker raised rates, throughout the 70s, there was very high rates of bank lending. The baby boomers were entering their home buying years, very high rates of bank lending and money creation from that source. And so raising rates can, put strain on borrowers and slow that down. In the current environment, the deficits are bigger than the net new bank loans per year. And in many years, even bigger than bank loans plus new corporate bond issuance. And so the effect is, maybe not quite as powerful. I don't really see it as bearish for housing when rates come down. I would be a little more concerned about equities because a lot of the global capital that's stuffed into the U.S. is in our equity market. That's one thing that kind of makes the U.S. somewhat different than other jurisdictions. Is a lot of other jurisdictions, capital goes into their housing market, right? So, for example, foreigners will buy houses in Canada or Australia, whereas when capital goes to the U.S., a lot of it goes into the equity market in particular, and that's the capital. Capital flows that I'd be more concerned about in terms of impacting investment performance.
Lyn Alden's analysis offers a thought-provoking look at the interplay between Bitcoin, global liquidity, and macroeconomic forces. Her long-term bullish outlook on Bitcoin remains intact, but she warns that the short-term environment is clouded by tightening liquidity and recalibrating expectations. At the same time, her insights into the political landscape, interest rate dynamics, and the potential for a rotation into international equities provide valuable context for investors navigating an increasingly complex global economy. Alden's emphasis on global liquidity as a key driver for Bitcoin and her analysis of fiscal dominance in shaping monetary policy will continue to be crucial factors for anyone involved in the crypto and financial markets. Investors would do well to heed her advice, maintaining a long-term perspective while staying informed about the broader macro trends that will shape the future of finance. Please like and subscribe my channel.